Welcome to the lecture on Unit 2 Accounting and Auditing. In this lecture, we will discuss about Introduction to Accounting, basic terminology, accounting concept, and accounting principles. Let's start with the evolution of accounting. In India, during the time of Chandragupta Maurya, Chanakya wrote a book named Arthashastra, in which we can trace some evidence of record keeping, recording of resources available, the production and distribution among people for future purpose, and sustainable estimated requirement in future. And in the year 1494, the Italian merchant Luca de Pasquale developed a double entry system of bookkeeping. Then, due to industrial revolution, large scale operations were carried on and requirement emerged to record transactions for many purposes and for many users. At present, we use these transactions for decision making and other branches of accounting. Let's start with the very basic meaning of accounting and what is the difference between term bookkeeping, accounting, and accountancy. So, bookkeeping is an art of recording business transactions in the books of accounts in systematic manner. Systematic manner means in chronological order. Chronological order means date wise. So, recording of business transactions in books of accounts in chronological order is called as bookkeeping. What is accounting? It is classification, summarizing, analyzing, and interpretation of recorded transaction. So, bookkeeping refers to recording of business transaction in systematic manner, but accounting is classification of recorded transaction. Classification, summarizing, analyzing, and interpretation of recorded transaction. In bookkeeping, we record all the business transactions date wise, but in accounting, we classify the business transaction on the basis of purchase, sales, incomes, and various types of expenses. So we provide them a particular category. So we classify the recorded transactions in ledger, summarizing. Summarizing means to give brief introduction. So for example, narration, we provide narration in journal entry. So some classification, summarizing, analyzing, it means to prepare financial statement or final account. So classification, summarizing, analyzing, and interpretation. Interpretation means, for example, ratio analysis to take various financial decisions on the basis of financial statement. So first we classify and summarize the recorded transaction, then analyze them and interpret to take proper decisions. So bookkeeping means recording of business transactions in books of accounts in systematic manner, and accounting is classification, summarizing, analyzing, and interpretation of the recorded transactions. So on the basis of bookkeeping, we can prepare accounting, and on the basis of accounting, we prepare accountancy. Now, what is accountancy? Accountancy is a base for decision making, which include human resource accounting or corporate social responsibility. So, accountancy is a wide concept. It includes everything. For example, taxation, etc. Now, let's move to the users of accounting. The users of accounting are owner, management, investor, lenders, government, and general public. The owner of the business is the user of accounting to know about the profit and loss at the end of particular period, say for example for a month or at the end of the year. So the owner is the user of accounting to know about profit and loss or assets and liability at the end of particular period. Then management team. In corporate sector, the decision making power belongs to the management to take financial decisions such as expansion, the investors are the users of accounting for a company. The shareholders of the company are the investors and the owner of the company. So, to take investing decision or investment decisions, whether to invest in particular business or not, to take investment decisions, investors are the users of accounting. Lenders of the business are user of accounting. Before lending money to business, they check solvency position to know whether business has ability to repay back or not. So lenders. Next, government to know about the tax liability. Different types of tax liabilities are there: indirect tax, direct tax, GST, timely payment of proper tax, timely payment of proper tax. Timely payment means before due date, and proper tax means as per provisions of the tax laws. And general public. The financial statement of various companies are published in business newspapers. So general public can convert into prospective investors and ultimately in shareholders or investors. So users of accounting are owner, management team, investors in case of company, lenders, government, public, etc. Next topic: basis of accounting system or methods of accounting system. It can be divided into cash system, accrual system, or mixed system. Accrual system is also called as mercantile system of accounting, and mixed system is also called as hybrid system. So there are three bases of accounting system: cash basis, accrual basis, and mixed system. Under cash system, only cash receipts and payments are recorded. Only cash receipts and cash payments. Or we can say that business transactions are recorded in accounts only when it is realized in cash. It is generally used by the professionals, for example, doctors, lawyers, or architects. Next is mercantile system of accounting system. Under this system, income are recorded when it is earned or received, and expenses are recorded when it is accrued or paid. For example, under cash system, the transaction for electricity bill paid will be recorded only when it is actually paid. But under accrual system, the transaction for electricity bill will be recorded at the time when electricity bill has come to the business. So the expense has been accrued but not yet paid. When it is paid, then it will be again recorded. Similarly, income has been earned but not yet received is recorded in accrual system but not under cash system of accounting. So under accrual system or mercantile system, income earned or received are recorded and expenses due, that is accrued or paid, are recorded. Next, mixed system of accounting or hybrid system. It is a combination of cash system and accrual system. Here, income are recorded only when it is received. Income and assets both are recorded only when it is received, but expenses are recorded when it is due. The main purpose behind this is to reduce liability. When income is recorded when it is received, so income will be lower and expense will be recorded at the time when it is accrued. So expense will be higher. So net profit will be lower and ultimately tax liability will be lower. But in India, the hybrid system of accounting is not allowed. So under cash system, the transactions are recorded only when cash is received or paid. Generally, professionals maintain accounting under cash system. The businessmen maintain accounts under accrual system or mercantile system, in which income are recorded when it is received or earned and expenses are recorded when it is paid or due. Under mixed system or hybrid system, it is combination of cash system and accrual system, in which income and assets are recorded on cash basis and expenses are recorded on accrual basis. But in India, it is not allowed to follow hybrid system of accounting. Let's discuss some accounting terminologies. Transactions. It means exchange of goods and services for consideration. Consideration means money. Transactions can be classified into monetary transaction and non-monetary transactions. Non-monetary transaction means barter transaction, barter exchange, or one goods for another. But in accounting, only monetary transactions are recorded. Non-monetary transactions are not allowed to be recorded. So monetary transactions can be cash transactions or credit transactions. Cash transaction means cash received or paid immediately are recorded. So cash transactions, for example, rent paid, salary paid, goods purchased on cash, or interest received in cash. So all these transactions, cash are received immediately or paid immediately. But in case of credit transactions, at the time of purchase or sale, the cash is not paid immediately. For example, goods are purchased from Mr. X on credit. Similarly, when goods are sold to customers on credit, so there is a transactions of sale, but cash is not paid immediately. So it is a kind of credit transaction. Similarly, when expenses are not yet paid or income is not yet received, it is also kind of credit transaction. For example, rent is payable. So rent is due, but it is not yet paid, but it is payable. Similarly, salary payable or outstanding salary, income receivable. So transaction means exchange of goods and services for consideration. It can be classified into monetary transaction and non-monetary transactions. Non-monetary transactions are barter transactions which are not allowed to be recorded in books of accounts. Only monetary transactions can be recorded. Monetary transactions means in which money is involved, and monetary transactions can be further divided into cash transactions and credit transactions. When cash is received or paid immediately is called as cash transactions, and when transaction happens but cash is not paid immediately at that time is called as credit transactions. Next is entry. Recording of business transaction is called as entry, and narration is brief explanation of transaction, and it generally starts with being. Narration starts with the word being. Being goods purchased from Mr. X on cash, being salary paid. Next, goods. It is a product of a business for the purpose of sale and to earn profit. For example, stationery products are goods for stationery business. Furniture is a good for furniture business. Now, one point to note here is furniture is a goods for furniture selling business, but for other business organization, it is an asset. Similarly, laptop, computer, all are goods for laptop selling company or retailers, but it is an asset for others. Residential flats or shops are goods for builders, but it is an asset for other business organization. Next is capital and drawings. When money is invested into the business, it is called as capital. It can be in the form of cash or kind. For example, 5 lakh rupees is invested into the business is called as capital in cash, and when laptop is bought into the business, the personal laptop bought into the business, it is called as capital in kind. When money is withdrawn from the business for personal use, it's called as drawings. Remember, money is withdrawn from business for personal use, then it is called as drawings. For example, tuition fee of children is paid from business money, or mobile phone gifted to the wife from business money. It is called as drawings because the transactions are for personal use. Next is debtors and creditors. Debtors is a person or debtor is a customer to whom goods are sold on credit. On the other hand, creditor is a person or creditor is a supplier from whom goods are purchased on credit and amount is payable. So debtor is the customer to whom goods are sold on credit and money is receivable, and creditor is a person or supplier from whom goods are purchased on credit and money is payable. So debtor is an asset because money is receivable, and creditors is liability for the business because money is due, it is payable. Now the money is not received from the debtor, or it is an irrecoverable money, is called as bad debts. The irrecoverable money from the debtors is called as bad debt, and bad debt is a loss for business organization. Expenditure: money paid by business for consideration is called as expenditure. There are three types of expenditure: capital expenditure, revenue expenditure, and deferred revenue expenditure. Revenue expenditure are regular in nature, regular expenditure. Capital expenditure are not regular in nature and long-term expenditure. For example, purchase of plant and machinery or any other fixed asset. So capital expenditure are long-term and irregular expenditure for the purchase of fixed asset. Revenue expenditure are regular expenditures which are paid for the operation of business. Revenue expenditures are paid for day-to-day, capital expenditure are paid for day-to-day business operations. Therefore, it is short-term in nature. And deferred revenue expenditure are revenue in nature, but benefit can be enjoyed for long term. For example, heavy advertisement or heavy legal expense, benefit can be enjoyed for 5 years. So advertising is the kind of revenue expenditure, but heavy advertising is the kind of deferred revenue expenditure. Benefit of this advertising can be enjoyed for more than 1 year. So expenditure can be classified into capital expenditure, revenue expenditure, and deferred revenue expenditure. Purchase of fixed asset are capital expenditure. Paying regular expenses are revenue in nature, and deferred revenue expenditure are a kind of revenue expenditure. The benefit can be enjoyed for more than 1 year. Next is discount. It is the concession provided by seller to the purchaser. There are two types of discount: trade discount and cash discount. Trade discount is a discount which is provided at the time of purchase or sale of goods and services, and it is calculated, but it is not recorded in books of accounts. But Cash discount is a discount which is provided by seller at the time of immediate cash payment. It is calculated after deducting trade discount and it is recorded in books of accounts. So remember, trade discount is not recorded in books of accounts, but cash discount is recorded in books of accounts. Let's take an example. If goods worth rupees 10,000 rupees is purchased and trade discount 10%, cash discount 5% is provided. So trade discount will be 10% of purchase price. So 1000 rupees will be trade discount. Purchase price is 10,000 rupees minus trade discount is 1000 rupees. Cash discount will be recorded on balance amount at the rate 5%. So 5% of 9,000 rupees, that is 450 rupees, and balance amount will be 8,550 rupees. So we can see that trade discount is calculated but not recorded, and cash discount is calculated after deducting trade discount and it is recorded in books of accounts. Next is solvent and insolvent. Solvent person is a person whose assets are more than its liabilities. The solvent person has an ability to repay its debts or loans. So, properties or assets are more to repay the liability is called as solvent person. And on the contrary, insolvent person is a person whose assets are less than its liabilities. Or we can say that insolvent person does not have ability to repay its debt because the property or asset is less than its liability. Its liability is more. Next is accounting year. It is the year for which business transactions are recorded in books of accounts. It can be calendar year or financial year. Calendar year means starting from 1st January to 31st December, and financial year means starting from 1st April to 31st March. So small business organization can select any year as accounting year. But large business organizations such as a firm, HUF, or cooperative society, a company can select only financial year as accounting year. That is from 1st April to 31st March. An accounting year for newly started business organization can be less than 12 months. Say for example, from 17th October to 31st March for first year. Then onwards, it has to follow 1st April to 31st March. So accounting year can be calendar year or financial year. Small business organizations can select any period as accounting year. But as per the Act, large business organization has to follow financial year as an accounting year. That is starting from 1st April to 31st March. Next is trading concern and not for profit concern. The main objective of trading business organization is to earn profit, but the objective of not-for-profit concern is not to earn profit but to provide services. They work for social welfare. Here, either profit or loss will be the result, but here the result will be surplus or deficit. Income minus expenditure is either profit or loss over here, but income minus expenditure, either it results in surplus or deficit. For example, footwear business, furniture, stationery business are an example of trading concern, and school, non-government organization, hospitals, charity, club are an example of not-for-profit concern. Next is goodwill. It is the reputation of a business in terms of money. Generally, reputation cannot be converted into money, but in accountancy, we have some formulas based on which we can calculate goodwill. It is an intangible fixed assets. Intangible means which cannot be seen or touched, unlike furniture and machinery. For example, Kalyan Jewelers. The reputation in the name makes it different from other jewelers. Next, income, revenue, and profit and loss. Income is revenue earned. It can be received or realized. For example, rent received or interest received, dividend received. So it is a kind of income. These are income. But it is not necessary that income is only that thing which is received. It can also be realized. That is, it is realized but not yet received. For example, goods are sold on credit. In this example, income is generated but cash is not received. So, income is realized but not received. Next is revenue. It is income earned from day-to-day business operations. That is purchase and sale of goods and services. So, revenue is a part of income. It means income includes revenue as well as other income such as commission received, interest received, dividend received, rent received, etc. Even when assets are sold, it is a part of income, but it is not included in revenue. For example, furniture sold. So, so income generated from the sale proceed of furniture is a part of income and not included in revenue. Next is profit and loss. When selling price of goods is higher than cost price, we can say there is a profit. When goods are sold on higher price than cost price, then it is called as profit. If selling price is less than its cost price, then there will be loss, and if income is greater than expenses, there is a profit, and if income is less than expenses, then there will be loss. But if sales price of goods is higher than its cost price, then it is a gross profit. And if sales price of goods is lower than its cost price, then it is gross loss. For example, goods costing 10,000 rupees sold at 12,000 rupees. So selling price is 12,000 rupees, 10,000 rupees is cost price. So there will be 2,000 rupees profit. And if income is higher than expenses, then there will be net profit. On the contrary, if income is lesser than expenses, then there will be net loss. So there is a difference between income and revenue. Revenue occurs from the sale proceed of goods and services. It is a day-to-day business operations. But income includes revenue as well as other income. That is commission received, interest or dividend received, or furniture sold, machinery sold. So these are the income. And if goods are sold at higher than cost price, there will be gross profit. Goods are sold at lower than cost price, there will be gross loss. If income is higher than expenses, there will be net profit. And if income is lower than expenses, there will be net loss. Next is assets and liabilities. Property of business is called as assets. For example, land and building, plant and machinery, furniture and fixture, closing stock of goods. These are the assets, and amount which are payable by the business is called as liabilities. For example, loans, salary payable or outstanding salary. Now, assets can be classified into fixed assets or non-current assets, current assets, and fictitious assets. Fixed assets are long-term in nature. The benefit of these assets can be enjoyed for more than 1 year. It can be further divided into tangible assets and intangible assets. Assets which can be seen or touched is called as tangible assets, and those assets which cannot be seen or touched are intangible assets. For example, land and building, plant and machinery, furniture are tangible fixed assets, and goodwill, patents, trademark, copyrights are intangible fixed assets. Current assets are short term in nature. The benefits can be enjoyed for less than 1 year. For example, stock, cash in hand, cash at bank, etc. And fictitious assets are imaginary assets which does not have realizable value. These are deferred revenue expenses, that is heavy advertisement expenses or heavy legal expenses, etc. There are three types of liabilities: fixed liabilities or non-current liabilities, current liabilities, and contingent liabilities. Fixed liabilities are long-term in nature. It means it is payable for more than 12 months. Generally, fixed liabilities are the sources of funds. For example, capital, loan from bank or loan from financial institutions. Current liabilities are short-term in nature. It means it is payable within 12 months. For example, creditors, bank overdraft, outstanding expenses, for example, salary payable or rent outstanding, etc. Contingent liability, which is payable or not, depends upon future uncertain events. It is not recorded in books of accounts, but it is recorded as notes to the accounts. For example, if, for example, court case by customer or worker is pending in current year, then it is contingent liability because it is not yet decided that we have to pay the liabilities or not. Therefore, it is a contingent liability. So there are three types of liabilities: fixed liabilities, which is also called as non-current liabilities, which is long-term in nature. Current liabilities are short-term in nature, and contingent liabilities. Contingent liabilities are not recorded in books of accounts. It is recorded as notes to the accounts. And the last point, capital. It is the amount invested in the business. It can be in the form of cash or kind. For example, business started with 5 lakh rupees cash and net worth. So capital and net worth, both the terms can be used interchangeably, but the word net worth is used in corporate sector. So assets minus liabilities are capital, or assets minus outside liabilities is net worth. Now let's discuss various accounting concepts and accounting principles. We use these two terms simultaneously, but there is a difference between concepts and accounting principles. Accounting concepts is the basic concepts which is applied everywhere in accounts, and accounting principles are rules of accounts which can be changeable depending upon the situation and requirement.